This is Natalie Brandt, Audience Development Manager at Citywire RIA. I'm here in Beverly Hills at the CAIS Alternative Investment Summit, and I'm joined by Matt Carvalho, Chief Investment Officer at Cardinal Point Wealth. Matt, how's the summit been so far?
It's been great. My third year here. Always happy to return. Apologize for the rain in Southern California this week, but hopefully everything's exciting indoors here.
Yeah. So just to start off on the more technical side, do you see alternatives like private credit or private equity being used in the average client's portfolio?
Yeah, we do. Maybe a little bit of background on kind of how our firm got there. Earlier in my career, I really started off on bond trading desks of banks. Then I went to a firm where we were really looking at equity factors. Working with Dr. Harry Markowitz and really kind of digging into mean variance optimization, and you're really trying to find those asset classes that can move a little bit differently than some of the other aspects of your portfolio. So it took me a little while to warm up to the idea of the alternatives areas and things like private credit, private equity. But I think over time, we probably took what's a pretty natural progression. First, you might be adding gold or commodities or REITs, things like managed futures, hedge fund strategies. But as we kept kind of going down the research, rabbit hole, we really found that some of these private markets can, play a very important role in a portfolio. And I think with, so much of the market today being still, privately held, you see the companies like SpaceX or Anduril or others, and they're growing so rapidly, but yet clients can't get exposure to them in the regular part of their portfolio they're managing. So over time, we've really brought that up to a bigger weight in portfolios. Today we typically see somewhere around 20 to 25%. We think it makes sense for a typical client of ours. And that could be a mix of some of those still, more public market hedge fund-like strategies that still have some more liquidity. And then another portion of that in some of the private markets that maybe have the semi-annual, quarterly, or even longer term liquidity structures. But I think it's nice to have a mix of those. Our clients still have 90%, call it, of their assets in pretty liquid vehicles. So we find that's a good place to be for most clients. But we've definitely appreciated kind of the benefits that we can get from some of those alternatives that we didn't have in the past.
And what about crypto? Do you see that ever becoming a part of the average client's portfolio?
Yeah, it's such a tricky issue, I think, for advisors, right? That, you can really have some tremendous gains there, but you could also have some very significant drawdowns and some clients kind of questioning, what is the real expected return here, right? Which I think is really hard to come to as an allocator. So, the way that we kind of approached it is back, a year and a half ago, early 2024, we wrote a series of some blogs and some newsletter pieces where we really kind of discussed crypto and some of the pros and cons of Bitcoin or Ethereum types of exposures. And then we kind of left it up to clients. We said at this point, we don't really feel that it's kind of, a table stakes thing for every client to have across their, across our practice. But we wanted to say, if this is an area of interest to you, talk to your portfolio manager, let's discuss it further. And then for those clients that wanted to, we then made some small allocations, 2 to 4% maybe, enough to kind of dip their toe in the water and participate in some gains if prices continue to rise. But that was kind of our way of, taking kind of a middle ground approach there and engaging with clients that wanted to.
So shifting a little bit, at Cardinal Point, do you use model portfolios?
We do. So, in our practice, our typical households, mid-single-digit millions of dollars that we're managing for them. So I think, in that kind of scenario, it's very effective to use model portfolios. And I think one of the main benefits of that is that we can create a whole bunch of different profiles for different types of tax situations, different client profiles, and the account status. And then we can say, okay, one of the benefits of using model portfolios is that when we as an investment committee go out there and do our research or feel that this other asset class, be it crypto or something else, it makes sense for a portfolio, we can then go and implement that pretty rapidly. So probably about a year ago up here at CAIS, I spoke to a lot of managers in the infrastructure space, and that was an area that we'd done research on and started to get more comfortable with at the time. And then when we wanted to move forward, we could say, okay, be it a 4% weight or whatever for different models, we can go in, maybe do some rebalancing, do some trims of some other positions to free up some capital there, and then across 1,000 or more accounts, we can allocate to those positions pretty rapidly. I think the other part too that's kind of benefited that is just more funds these days that either have more ticker traded types of options, or a lot of the changes here that CAIS has made over recent years. So we've been working with them for about 3 years now, and I'd say it's been great to see that their platform's been evolving over time. It's getting easier and easier to utilize the positions through them. For a firm like ours that didn't have much of a background in the alternative space or in the institutional space, that's been pretty key, because there's definitely a learning curve, kind of initially ramping up. And so the more that, we can rely on a platform like CAIS to, kind of help us leverage their expertise there, make things a little bit more efficient for, us internally as well as our clients, that's been a big benefit.
Now, just one final question. I'm curious to hear your thoughts on semi-liquid public and private investment vehicles, given concerns around liquidity and fees and a limited track record.
Right. Yeah, it's an interesting space. I mean, there's a lot of big players in the private markets that are starting to enter that space, and I mean, we're a big fan of liquid vehicles. ETFs and things are the vast majority of our clients' portfolios. But I think we've been a bit hesitant, or I don't think we're going to be necessarily a first mover in this space. There's some ideal benefits that you could bring in, and particularly when you look at areas like fixed income, certainly the higher yields in private credit are very attractive. So I see the desire for people to get more exposure there. But I think to date we've kind of looked at it and said, we have some good public fixed income managers and ETF wrappers or very liquid pieces, and we have some good private credit managers in these interval funds or other structured vehicles that are I think a little bit more efficient to utilize that way. That kind of helps us make sure that we have the liquidity needed, can have those targets available. I'd love to see more continued innovation in the space over time, and maybe down the road we will start to adopt those. But I think early on, we have just some questions around, okay, will kind of the liquidity be there when you need it? Will you be able to access the best investments in the private markets, or are those going to be best addressed through traditional private market vehicles?
Well, thanks so much for chatting with us, and I hope you have a great rest of the summit.
Yeah, absolutely. Thank you.
This is Natalie Brandt, CityWire RA.